Record inflation and now a federal interest rate hike unlike any the country has seen in decades. We're going to talk about what that means for you. In today's KSAT Q&A, we are happy to welcome Dr. David MacPherson, professor of economics at Trinity University. Thanks so much for being here with us to explain what we need to take away from this 0.75% interest rate increase today from the Fed. First of all, what's the goal in the Federal Reserve doing this?
The goal is to reduce inflation, and it's trying to reduce it by reducing people's spending and trying to reduce the demand for goods and therefore lower the inflation rate. That's the ultimate goal.
How did we get to this place with inflation? I mean, how did we get to the place where we're seeing rising prices, that things seem to be out of control and the Federal Reserve is trying to control things a little bit more? I mean, am I terming that the right way?
Yes. I think it's a couple of causes. One is it started off with too big a stimulus spending financed by the Federal Reserve. The bailout package we had in 2021 was too big for what was really needed for the economy, and it was paid for by, in essence, printing money. And also we had supply chain issues. So you have too much money chasing too few goods, and then you're going to get inflation.
And is it correct to categorize this as a first for the U.S. in terms of this sort of inflation, the impact that we're all feeling right now? Is this the first time we've been here?
No, we also had a real bad spate of inflation in the 1970s and early 80s. Where we actually had even higher inflation running in double digits, low double digits.
Any lessons learned from that you could see being applied today?
Yes, what happens, people had high expectations of inflation, and so that really got built into the economy. So the Federal Reserve had to raise interest rates to 20%, which caused a severe recession to wring that inflation out of the economy.
When you look at stocks right now, a lot of people have 401ks, a lot of people worried about their retirement. Is the stock market reacting to what the Fed is doing and inflation? Is that what we're seeing reflected in the stock market, or is there more at play there?
Well, today it was clearly the stock market went up. And the reason why is that going up 0.75 percentage point instead of a half was indicating that the Fed was serious about fighting inflation, so that investors had more confidence in the Fed that the inflation rate would come down in the future. And I think that's really the main story behind it. But generally, higher interest rates are bad for stocks because it makes other investments more attractive, like bonds.
Whether viewers at home watching this are familiar with the stock market or not, none of this sounds like good news. So what is the impact going to be to the average person with this interest rate increase, and when could we start to see that?
Well, you're going to start seeing some effects pretty quickly because some rates are tied to the federal funds rate, which is the rate the Fed controls. And so it's going to ripple through the economy. But it's going to take time to fully get there. It could take 1.5 years to have the full impact of this change. But it'll start relatively quickly.
When we talk recession, and then I said we heard a new word today that was introduced, not new, but a new term that we haven't heard in a while called stagflation. Are you confident that what is going to happen is going to not affect people? Or is a recession inevitable? Is stagflation something we should be worried about? I mean, what are you seeing for the average American out there when it comes to prices, when it comes to retirement and stocks?
Yeah, in terms of the recession, I think that's got a higher probability now than in the past because the Federal Reserve is going to have to really increase interest rates to get this inflation under control. And their track record of avoiding a recession, what economists call soft landing, has not been good. So the odds of having a recession are pretty high. Obviously, we've lost over 20% in the stock market already this year, and we're in a bear market. And so that's going to hurt people who are retiring in the near future. So I would expect that would, previous recessions or declines like this have shown that people tend to work longer who are close to retirement as a result of these declines because their value of their pension fund has fallen.
Can you explain a bear market for us?
Oh, sorry. Good question. Bear market is when the stock prices have fallen at least 20% relative to their previous peak. And that's what we're in right now.
And he said in the past, how long has it taken to rebound from a recession?
Well, the longest ones are the 2007 to 2009. That's one of the longest ones in recent post-war history. And that was December 2007 to June 2009. So it's about a year and a half. And of course, you had the Great Depression, which lasted almost a decade. But since World War II, a year and a half would be a upper bound typically. Other recessions tend to be shorter.
I'm curious if you have any indication on the flip side of that from where we are now until officially entering a recession. What's the timetable look like given our current conditions?
Well, I would be surprised in the next year we start to enter a recession. And a recession is defined as 2 quarters of falling output in the economy. And so, this Federal Reserve hikes in interest rates are going to start to cut people's borrowing and therefore spending.
And then that will bring inflation down, which they want to. But like you said, there's not going to be if we go into a recession, that's not a soft landing. David MacPherson.
That's right.
Yeah, David MacPherson,
that's
economics.
A hard landing. Yeah,
it's a very hard landing. David MacPherson, economics professor at Trinity University. Always appreciate your time, sir.
Well, thank you.